The Fed just shocked everyone with another interest rate hike. In a decision that shocked investors and economists alike, the Fed has announced to increase interest rates by 25 basis points. This could mean big trouble for your investments. Are you prepared? $16.15 trillion. That's how much debt Americans have accumulated by the second quarter of 2022 alone. A massive 41.79% jump from just $11 trillion just a decade ago. On top of this, nearly half of the population doesn't even have enough savings to last 3 months if they lost their jobs today. So what can the Fed do to battle inflation? Increase interest rates. But wait, how exactly does this help the situation? Will the interest rates go even higher in the future? How will this affect your wallet? Watch this video as we uncover the truth behind increasing interest rates and tell you how you can battle inflation. Before we begin, make sure to hit the subscribe button and click on the thumbs up icon so you can stay updated with what's coming ahead for your wallet. Now let's dive in. Interest rates go off the chart. The Federal Reserve increased the interest rates last week to a 16-year high. This is the highest the interest rates have been since 2007. The Fed says this is just to keep the inflation in check and to restore it to its 2% target. Now, why would you worry about this? Last time interest rates were this high, it was 2007, and we all know what happened in 2008. That's right, the financial crisis. Historically, recessions have often been preceded by a rapid rise in interest rates. This is because higher interest rates can lead to a decrease in consumer spending and business investment, which can in turn lead to a decrease in economic growth. If the current interest rate increases continue at their current pace, there is a very real possibility that the U.S. economy could slip into a recession in the near future. A close look at this graph shows that the U.S. interest rates are well over projections, and the Fed is definitely not happy. The interest rate in the United States has averaged 5.42% from 1971 until 2023, reaching an all-time high of 20.00% in March of 1980 and a record low of 0.25% in December of 2008. This is clearly evident from the peak in this graph, but as you can see, these rates have been going lower ever since. The graph below shows how these rates have been crawling back up ever since. How this affects you. Fed Chairman Jerome Powell said the U.S. economy has started to see disinflation and also projected confidence in the banking sector's health. But are these claims really true? We are still very far from Powell's 2% target. The rising cost of borrowing is wreaking havoc on corporate profits and sending shockwaves through the stock market. The S&P 500 has plummeted a jaw-dropping 16% since the beginning of 2022, leaving investors reeling. But the damage doesn't stop there. The financial system is showing signs of weakness and instability as institutions struggle to operate in this increasingly difficult environment. Just this month, Silicon Valley Bank and Signature Bank failed to keep their heads above water, succumbing to the immense pressure of higher interest rates. These are just the first signs of what could truly be a devastating economic collapse. And it's not just smaller institutions feeling the heat. Even the largest banks in the country are struggling to cope with the liquidity issues brought on by the interest rate hikes. San Francisco-based First Republic, despite receiving support from the federal government and the country's biggest banks, is still grappling with major liquidity issues. But what about you, the everyday consumer? Let's take a closer look at some scenarios to see how bad it could get. Scenario 1. The mortgage holder. If you have a mortgage, you could be in for a rude awakening. For example, let's say you have a $200,000 30-year fixed-rate mortgage at 4% interest. With monthly payments of $955, you're already stretching your budget. But if interest rates rise just 1% to 5%, your monthly payments would jump to $1,073. That's an increase of $118 per month, or $1,416 per year. And if interest rates rise even higher to 6% or 7%, your monthly payments could skyrocket to $1,199 or $1,346 respectively. Scenario 2. The credit card user. If you carry credit card debt, rising interest rates could hit you hard. For example, let's say you have a $5,000 balance on your credit card with an interest rate of 16%. If interest rates rise by just 1% to 17%, you'll end up paying an extra $50 per year in interest. But if interest rates rise by 3% to 19%, you'll end up paying an extra $150 per year. And if interest rates continue to climb, you could be looking at hundreds or even thousands of dollars in additional interest payments. Scenario 3. The auto loan borrower. If you have an auto loan, rising interest rates could make your payments more expensive. For example, let's say you have a $20,000 auto loan at 5% interest. Your monthly payments are $377. If interest rates rise by 1% to 6%, your monthly payments would jump to $386. That's an increase of $9 per month or $108 a year. And if interest rates continue to climb, your payments could become even more unaffordable. This is clearly evident due to the crashing car market recently. Subscribe to our channel if you want a video on that soon. Scenario 4. The small business owner. If you own a small business, rising interest rates could make it harder to borrow money. This could limit your ability to expand or invest in new equipment or technology. For example, if you're looking to take out a $100,000 loan at 5% interest, your monthly payments would be $1,610. But if interest rates rise by 2% to 7%, your monthly payments would jump to $1,937. That's an increase of $327 per month or $3,924 per year. Scenario 5. The student loan borrower. If you have student loans, rising interest rates could make it harder to pay off your debt. For example, let's say you have $30,000 in student loans at 6% interest. Your monthly payments are $333. If interest rates rise by 1% to 7%, your monthly payments would jump to $346. That's an increase of $13 per month or $156 per year. And if interest rates continue to climb, your student loan debt could become even more unmanageable. These were only 5 examples. You can only imagine how worse this gets. The real reason behind increasing interest rates. So why are interest rates rising so rapidly? And how can this help the economy? To understand this better, let us go back to the basics. A central bank is basically the bank of all banks. All commercial banks have a standard reserve. All banks can loan each other's reserves to each other at an interest rate determined by the Federal Reserve. When the Fed increased the interest rates, it quickly spread across the entire financial chain. Central banks to commercial banks and commercial banks to the people. Let me explain easily. Imagine you're at an all-you-can-eat buffet. You grab a plate and start piling on food. At first, you take just a little bit of everything, but then you see some of your favorite dishes and you start loading up. Soon, your plate is piled high, and you're struggling to carry it all. This is a bit like what happens when inflation starts to rise. Inflation occurs when prices of goods and services increase over time. At first, prices may rise just a little bit, but then they can start to climb more quickly. If left unchecked, inflation can become a serious problem, as it can erode the value of money and make it harder for people to afford the things they need. This is where the Federal Reserve comes in. The Reserve is like the manager of the buffet. They're responsible for making sure there's enough food for everyone, but they also need to make sure that people don't take too much and waste it. One way the Federal Reserve can combat inflation is by increasing interest rates. When interest rates are low, it's easy for people to borrow money and spend it, which can drive up prices. But when interest rates are high, it's more expensive to borrow money, which can slow down spending and decrease demand. This in turn can help to stabilize prices and combat inflation. Think of it this way. If the manager of the buffet sees that people are taking too much food, they might start making the plates smaller or putting out less food. This could help to slow down the rate at which people are eating and ensure that everyone gets a fair share of the food. Similarly, when the Reserve sees inflation starting to rise, they can increase interest rates to slow down spending and keep prices under control. What to expect further? The Federal Reserve has revised its economic forecast for the future. In accordance with past estimates, the committee believes the central bank will continue tightening until the terminal Fed funds rate hits 5.1% in 2023. The Federal Open Market Committee's dot plot of members' interest rate forecasts implies that the Fed will continue raising rates until at least 2024, and then begin cutting them. Both unemployment and GDP growth forecasts for the United States were updated by the committee. From 4.16% in December, they anticipate a decrease to 4.5% in 2023. However, they reduced their estimates for GDP growth in 2023 and 2024 from 0.5% and 0.6% respectively to 0.4% and 1.2%. The Fed has also raised its inflation projection for 2023 from 3.5% to 3.6%. Investors are worried that the Fed won't be able to rein down inflation without ushering in a downturn. As a result of the news, the S&P 500 initially rose, with some investors hoping for rate decreases as soon as this summer. Many seem to be enthusiastic about the anticipated 25 basis points rates rise and the remark that the banking system remains healthy, according to Quincy Crosby, chief global strategist at LPL Financial. Jamie Cox, who's the managing partner at Harris Financial Group, stated that the end of the rate hiking cycle is near. After all, the Fed doesn't want to destroy the economy in its attempt to battle inflation. Do you have any credit card debt? Let us know in the comments below. With this, we put an end to this video. While the Fed increasing interest rates could have alarming implications for the economy, we must understand that this is being done for the greater good. In order to keep up with the rising rates and the ongoing financial turmoil, make sure to watch your purchases, only buy what's absolutely necessary, and keep yourself updated with the latest buzz in the industry. Hit the subscribe button and we will keep you updated. If you like this video, do hit the like button. We will soon be back with more.